The next topic we have is notes to financial statements. First of all, US GAAP tells us that companies must describe all important accounting policies that the companies use in their financial statements. The best way, the right way, is to put this information either as the first or second note in the notes section of the financial statements, because it is important that these policies are only mentioned in a particular section and they are not repeated elsewhere in the notes. So this summary will help users of financial statements. There are many users of financial statements: investors, prospective investors, maybe bankers, regulators, stock market analysts, so that these users, they understand how the financial information was prepared. So let us discuss what kind of information that should be included in the summary of significant accounting policy section of financial statements. First, we are going to summarize important accounting policy. Measurement basis used in preparing the financial statements. It means how the company values its assets, its liabilities. For example, if a company values its building at the price they originally paid for it, which is called historical cost, or would they use current market value? So they need to disclose whether they use the historical cost method or the current market value method. So they might say the buildings are recorded at historical cost. Normally, as we proceed, we'll learn that in the US GAAP, we use historical cost. There are certain assets which are valued at a market price. Next, specific accounting principles and methods used during the period, including basis of preparation, means how the company combines the financial information of all its subsidiaries into one report. Maybe I'm the parent company P, I may have a subsidiary A, B, C. So how do I combine? Like, I might own several smaller companies, so how would I disclose all subsidiaries wherever I hold more than 50% ownership? They require to be fully consolidated. We have already discussed this previously. Depreciation method. Depreciation, I'm sure you all know, this is how the company spreads the cost of its fixed assets over time. So if a company uses the straight line method, which spreads the cost of an asset over its useful life, they might say office equipment is depreciated using the straight line method over 5 years. Amortization of intangibles. It means how the company gradually writes off the cost of intangible assets, which I'm sure you all know. Patents, trademarks. So how do we write them off over time? For example, a company might say our patents are amortized over 10 years using straight line method. So you have to describe your policies. Inventory pricing. It's how the company values its stock. If the company uses first in, first out, FIFO, or does it use last in, first out, which is permissible under the US GAAP, so you need to disclose. Then, use of estimates. There are many situations where the company must make some educated guesses because the exact amount cannot be determined. For example, a company might estimate the amount they will lose on bad debts, so they need to disclose. So you need to disclose the policy related to your account, uncollectible accounts. So you may say something like this: estimates are made for doubtful accounts based on historical data and the economic conditions. Fiscal year definition. It defines the 12-month period used for accounting period. Is it from 1st Jan to 31st of December, or is it from 1st of July to 30th of June? So if a company doesn't follow the calendar year, they would say our fiscal year ends on March 31st, for example. Then we have some special revenue recognition issues. Means how the company recognizes revenue in complex situations like a long-term construction contracts, or maybe like in leases. For example, if a company works on projects that last several years, so they may state their policy this way: the revenues from long-term construction contracts is recognized based on the percentage of completion method. So that's how they need to disclose. So these disclosures are important because they help anyone reading the financial statements understand how the company is managing and reporting its finances. Remaining notes to financial statements. These are additional details that the companies provide in their financial statements. Basically, these notes give extra information that helps investors, creditors, and other decision makers understand the company's financial situation better. So let us discuss what are the elements included: inventory and property, plant and equipment. This note includes important details about company's major assets like inventory, building, machinery. For example, if a company inventory includes items that might become obsolete soon, maybe perishable items, due to new technologies, they need to mention that fact in the notes. Changes in stockholders' equity. This note explains any changes in the ownership equity. I'm sure we have discussed this in the previous classes. So this note explains the changes that have occurred in retained earning and equity. For example, if company issued new shares or bought back some shares of its own from the market called treasury stock, they need to disclose these details. Marketable securities. This note basically talks about the company's investments in stocks, investments in bonds or other securities, including their current market value and any gain or loss unrealized or realized thereon. For example, if a company owns a stock in another company, X company, for example, so they need to show how much it is worth now compared to what they originally paid. Maybe we purchased X stock during the year for $100, let's say, and at the end of the year, either it's more than 100 or less than 100. So you need to report what is the current market value of these. Next concept is fair value. That means company needs to disclose the fair value of certain assets and liabilities. For example, if the company has real estate, they might estimate this current market value, which could be different from the original historical cost. Contingency losses. This note covers potential losses that the company might face, but we are not yet certain. For example, one of our employee got injured and he has filed a case in the court of law against the company. So we are not sure what we may have to pay against these damages claim, right? So, but we need to disclose if there is some possible financial impact of such a lawsuit filed against us. Contingency gain. This note discusses potential gains that are likely, but we are not yet sure because they are not yet guaranteed. So, but just with a warning to avoid misleading public about the financial statement. So we don't report them within the body of income statement. We write them in the notes form, right? So if the company, for example, if a company expects to win a lawsuit and it expects to win some settlement money, they might mention it, but you cannot create it as an income use so as to avoid creating any false expectations. Contractual obligations. This note will detail the company's long-term financial commitments, like if you may have taken loans or you may have to pay some bonds payable. So if company has a loan that requires certain assets to be kept as collateral, so you need to disclose which assets are collateralized under what kind of debt arrangement. Pension plan. Yes, this note provides details about the company's retirement plan for its employees. For example, if the company offers a pension plan, they would also explain how it works and how much they are obligated to pay. Then we have segment reporting. We have discussed this previously in our income statement topic. This notes break down the company's financial results by different parts of business. That's what we call segmental reporting. If company operates in both retail, for example, in manufacturing, and in some service area, they would show the profit and losses of each segment separately. Subsequent events, this is the topic we will be doing in the coming classes. This note covers significant events that happened after the reporting period. Maybe your financial statement are closed on 31st of December 2025. Something happened on, let's say, 15th of January 2026, 15 days after the close of balance sheet. So, is it an adjusting event or not? This is the topic we will discuss in the next class. So, that's what you call the events occurring subsequent to the balance sheet date, right? So, this note covers any significant event that happened after the balance sheet date but before the financial statements are issued. Let's say our financial statements are issued on 31st of March 2026. So, this event has happened between the balance sheet date and the reporting date. For example, if a major customer declared bankruptcy on 15th of January, after the end of the year, 31st of December 2025, the company would need to disclose this even it has happened after the balance sheet date. Next, we have accounting changes. This note explains any changes in how the company prepares its financial statement. If the company switched from one accounting method to another, they would need to explain this change and its impact on the financial statement. Okay, now we're going to discuss the requirement for companies to disclose any risk and uncertainties related to their operations as a part of their financial statements. So under the US GAAP, there are certain requirements and we are going to discuss these one by one. And we are specifically talking about we need to disclose the nature of our operations, what actually we do. So this section of financial statements footnotes should describe what the company does, including our main products, our main services, where we sell them. So if the company has multiple businesses, it should explain how companies, each segment is performing. It should explain how important each one is to its overall objectives or for overall company. For example, let's say for retail company, a company like Walmart, it might explain that we operate retail stores across the United States and several other countries. And they might say that our primary products include groceries, apparel, and electronics. So the US market, they may say that it accounts for 80% of our revenue. So they need to describe the nature of their operations. And let's say if we are a tech company, let's say like Google or maybe a Microsoft or Apple, let's say. So what we would include, so we say we develop and sell consumer electronics, we provide software and services globally. Our main products include iPhone, Mac computers, and various services such as iCloud. And then we may say the iPhone generates 50% of our total revenue, making it the most significant part of our business. So we may include this is important. This kind of disclosure helps investors and other readers to understand what the company does, where it operates, and which parts of the business are most important to its financial health. So it also gives insight into potential risks or uncertainties related to different aspects of the company's operations. Use of estimates in the preparation of financial statements. When companies prepare their financial statements, they often have to make some estimates, some educated guesses about certain figures because the exact numbers aren't always known. These estimates can affect how your assets are reported, how your liabilities are reported, how revenue expenses are reported. So the disclosure is an important one because actual results might turn out to be different from estimate. For example, say a company might estimate that maybe 10% of our account receivables may not be collected. So we may report this 10% as an expense, as a loss, as an estimated loss. But it is not the actual amount of loss. Maybe the amount could be more than 10%, amount could be less than 10%, because estimates do not always mean this is the actual figure. Similarly, for another company that sells electronic gadgets, they might estimate that some of their inventory items may become outdated and such items may lose their value before they can be sold. So they need to book an estimated loss, the reduction in the value of the inventory as a loss. Same is true for warranty liability. I'm sure you remember when a company sells its products with the warranty, then company must, like for example, I have sold goods worth $100,000 this month. And based upon the past experience, it appears that of this sale, maybe 3%, $3,000, may have to be paid against the sales for warranty claims. So in the same month when the sale is made, we record this estimated warranty liability. It's an estimate. Maybe actual expense could be more than 3,000 against warranties. It could be less. So that's the basic idea, that we are not sure. It's just the guess. So the important point that I want to make is that company needs to include in the footnotes that it uses estimates in preparing financial statements. And the actual results may be different from these estimates, so that the readers are not misled. Certain significant estimates These are important estimates that could change in the near future and have significant impact on the company's financial situation. So let's take some examples. Technological obsolescence, where there is a possibility that an important estimate might change soon regarding the product we sell. Maybe what we sell, it may quickly lose value because of new technological breakthrough made by some competing businesses. So we need to report this. For example, we are a tech business and we sell smartphones. Smartphones, we have maybe a stock of smartphones valuing $10 million, right? Now, there are many competing businesses that have brought significantly improved products in the market, and it appears that 20% of this value is finished. New technology has resulted in a probable likely decrease in your sales, and you might you think that 20% of the stock is gone, means the value of the stock is finished by 20%. But in actual, the fall could go as high as 50%. So this is the significant change that needs to be reported. Next is deferred tax valuation allowance. This involves estimating whether the company will be able to use certain tax benefits in the future. For example, we have some previous tax assets which we can adjust against tax liability dating from the last year 2025. So will we be able to adjust, will we be earning sufficient income so as to adjust this tax benefit against the tax payable? Capitalized computer software cost. It means the cost of developing a software which are spread out over the estimated life of the software. Let's say we spent $2 million on developing a software, and this $2 million is expected to benefit us over the next 5 years. But if the software becomes obsolete after only 3 years due to new technology, the company will need to adjust this estimate. Next, we have is the loan valuation allowances. Loan valuation allowances involve estimating how much of the loan given out by the company might not be paid back. Especially for a banking institution. A bank may have loaned out 100 million to various borrowers, and it expects that 2% of the loan will not be repaid, and so they set aside a loss equal to 2% of 100 million, that is $2 million is the likely loss. But if the economy worsens, this estimate might need revision to 5% or maybe 10%. Next, litigation related obligation. This is about estimating how much money the company might have to pay if it loses a lawsuit. Like one of our employees got injured, he filed a case against us in the court of law asking for $10 million compensation for the injury caused. So if we lose this case, that's what we may have to pay. But things can twist in totally different direction. Maybe the court raises this penalty to $50 million. So this was the loss we may have noted in our contingent liability, or maybe we might have booked it as an expense, as a potential liability. But eventually when the decision was made by the court, it was $50 million. So do we need to adjust this estimate? Then we have a long-term obligation. Long-term obligation means estimating the cost the company will incur in the future for employees' pensions and other post-retirement benefits. That's the company's obligation. For example, a company might estimate that it needs $10 million to cover future pension. But if life expectancy increases, they may have to pay $12 million. Right? That needs revision. Then long-term contracts. It means estimating revenues and cost for a contract that lasts several years into the future. For example, a construction company working on a multi-year project might estimate that the total cost for the project is $150 million. It will last for, let's say, 5 years. But if the material price rise unexpectedly by 15%, the company may need to revise its estimate. So all these estimates that we have discussed, they are important because they can significantly affect the financial health of the company. If it's likely that these estimates will change in the near term and the change will have big impact, the company must disclose this potential change for the understanding of users of financial statements and many other stakeholders. Current vulnerability due to certain concentration means situations where a company is at a risk because it depends on too much on a single factor. On a single factor means you are too much dependent on a single customer. If he goes, you are finished. Or maybe you depend too much on a single supplier. If he stops selling you, you are finished. Or maybe you're dependent too much on a single product or a region, and if these changes, you are gone. So this is risky because if something goes wrong with that one item, the company could suffer significant losses. So what are the disclosure requirements? The company must tell people about these concentration risks in their financial statements, because if they don't, then that will be like misleading the users of financial statements. So US GAAP says that if 3 conditions are present, then you need to disclose about this concentration risk. First, the concentration is still present. Second, the concentration could cause a major problem for the company, right? And third, it is likely that something could happen in the near future that would make the concentration a serious problem. So if all of these conditions are present, then company must disclose concentration risk. First, the concentration is present when the financial statements were prepared. 2, the concentration could cause a major problem for the company soon. 3, it's likely that something could happen in the near future. Next, there are certain examples of concentration. Let us discuss few. First, concentrations in the volume of business transacted with a particular customer or supplier or a lender or a contributor, for example. For example, if a company has 90% of its sales from a single customer, losing that customer, you're finished. Second, concentration in revenue from a particular product. If that product is gone, you are gone. Third, concentration in the available supply of resources such as material, labor, or services. If a company depends on certain rare material from a single source, if that source isn't available, you are in trouble. And then finally, concentration, these are given in your textbook, in market or geographic area. If you are maybe concentrated in a very narrow geographical area, let's say you sell to a particular country, you are at risk because if that country faces an economic downturn or maybe changes in its law, you are out.